Hello everyone, today is Friday, August 5th, 2022. My name is Evan. I want to welcome you back to another edition of Stock Market Weekly, episode 643, presented by The Trade Risk, where it is our job to break down the most important trends, price action, and noteworthy moves that you may have missed across financial markets. If it's your first time tuning into one of our videos, welcome. Thanks for being here. And here's how they work. We break up our analysis into two distinct parts. In part one, we look at everything that went on this week in markets. We go through the numbers and pick apart things that stand out, look different, interesting, or notable. And then in part two, we jump into the charts. We take a close look at price action and try and best position ourselves looking ahead. So hopefully that sounds good to you. Lots to get to in this week. So let's jump right into some of what we're going to be talking about in this week's episode. First and foremost, Nasdaq FOMO squeeze is continuing to the upside. We've got the US dollar, which found some support this week, so finally starting to stabilize a little bit after it was pulling back for a couple of weeks. We're going to be looking at some cycle work from my friend and well-respected trader Larry Williams, and we're also going to be looking at what the yield curve is showing us, and we've got some interesting breadth studies we're going to show in the second part of this video, and also getting pretty specific with price action, given that we have run up quite a bit now in a short amount of time. So lots to get through. Let's jump into the numbers here. You can see on the week, mostly positive. So the S&P 500 just a bit over par, over zero this week, 0.36% to the upside. The Nasdaq 100, though, was the big winner, and really the Russell 2002. Both of those indices were up 2% on the week, and world stocks, you can see, started to pull back. You can see the 1 month numbers also now starting to get into almost double-digit territory here for the Nasdaq and the Russell. So some very good recent performance, of course, over the past 20, 30 trading sessions. Now, stock market trends, something we look at every single week here, and the 10 SMA has been rising now for about 3 or 4 weeks. And so there's nothing new there. Over the past couple of weeks, we've started to see the 50 SMA actually begin to rise in 3 of the 4 of our indices that we're looking at here. None of the longer term 200 SMAs are changing shape right now. So right now we have basically the short and intermediate term, which are pointing up, and what you could consider to be a counter trend rally in against the longer term declining 200 SMA. Now, in terms of volatility environment, this continues to be a sort of a wind at the bull sails back, let's call it. The volatility index for the S&P 500, the VIX, closed around 21 going into the weekend. So you can see that we are continuing to see lower lows here, new recent lows for the Nasdaq, for the S&P 500 volatility index. And now for Nasdaq, you're seeing basically a similar situation here. We're below that 30 level, and we're at 27 here, which is again a new recent low for volatility. So both of these things have been pretty bullish for the past several weeks. We've basically just seen the volatility balloon deflating, and that continues to sort of support this market rallying higher. Now, NYSE 52-week highs and lows here. We track this every single week, of course, and we were noting over the past couple of weeks that we finally started to see the number of new lows start to dry up a bit, but we didn't quite get the uptick yet in the number of new highs. And that still is sort of the same basic dynamic that we're seeing this week. We're getting basically an even race here, and you know, a way to think about this is there's a lot of stocks, right? If you think about a channel that is effectively, you know, kind of going sideways. You've got the upper bounds up top and you've got the lower bounds down below, and you're essentially not getting any of the stocks really trading at many of those extremes. So you're just getting a lot of stocks kind of wading through the middle ground, let's call it, if that visualization helped at all. But basically here we're seeing kind of an even race. We're seeing a balance here. We did get 34 net new 52-week lows made this week, which is basically, again, just kind of noise and pretty much a zero. So we want to see, you know, the bull case here to increase the number of stocks hitting 52-week highs. That's what the bulls want to see here. And if we don't start to see that soon, and we get this market kind of just floating in no man's land, then, you know, you do have some risks here of the lows kind of opening up if this market does, in fact, lose steam and begin to break down. Now, in terms of sector performance this week, you can see, again, mostly positive, but very split. So you had technology, communication services, and discretionary at the top of the list here. They're up 1 to 2% on the week. And you can see, again, 1 month numbers for some of these individual sectors now are very much in double-digit territory. So some of the indices haven't quite gotten there, but if you're looking at tech specifically, it's up 10.65%, consumer discretionary up 12% on the month. So that, or over the past 1 month. So that is pretty aggressive in terms of leadership. But on the downside this week, we saw energy really start to pull back pretty hard this week, 6.81%. It's seeing lots of volatility out there. It was up very large, pulling back very large. So it's just elevated swings and lots of volatility basically in this sector right now. Real estate and materials were the second and third underperformers on the week. Now, in terms of correlations, we're still seeing lots of bright green and lots of bright red in here. So again, things are very much moving, very tightly correlated to one another. And what's fascinating here is, in fact, actually this move in gold, and silver and some of these commodities here. Look at the correlations between what gold is doing and what the equity market is just broadly doing here. And again, these are only 5-day correlations. So we're looking, 10-day correlations. So things are pretty short term, but you're just seeing lots of tight movement here, and you're seeing it all really tied to what the US dollar is doing. And so as the US dollar started to rebound this week, we started to see a little bit of pressure put on some of these commodities and start some of the indices, or S&P at least, pull back a little bit. And that continues to play itself out. So pretty interesting dynamics going on there. Bitcoin seems to have dropped correlations from most things over the past 10 trading sessions. All right, now if we bring our attention to Treasury yields, you can see they were up across maturities this week. So we did finally get a sort of reflex rally back to the upside. If you recall, last week we were sort of, celebrating that the 10-year yield, Treasury yield was breaking below 2.7% and was starting to, retrace to multi-month lows. And now here we go, kind of rebounding up again, back up to 2.84. So this is something we'll, again, keep our eye on right now. The trend over the past, handful of weeks has been lower across Treasury yields. And that's been, partly what I would say is helping, fuel some of the rally that we've seen in growth and tech assets. And now, if we start to get a big rebound or sharp move back up, that could certainly, put the brakes on the stock market rally. So we're going to keep an eye on it, but we did get, basically moves up across the board. If we look at dollar and commodities this week, again, the dollar also finding a bid this week, so up 0.74%. It's been sliding over the past handful of weeks. We did see gold manage to stay positive this week, although off of its highs. So that was, I guess, mildly constructive there for the bulls. We saw basically everything else trade lower, though. We saw agriculture ETF here, DBA. We see Bitcoin, silver, natural gas, especially crude oil, all negative this week. So a couple of things I want to finish off here on our free video. First is the 8-year cycle, and this is work done by Larry Williams. He was recently on StockCHARTS TV, so I definitely recommend checking that out. I will try and remember to put a link in the description of this video so you can go find this video. He did a presentation, I believe it was at some point this week, and I happened to catch the recording of it. And I love Larry Williams' work. I think he's just a great market technician, great thinker, and he's been in markets for forever. And so he was speaking on this 8-year cycle. And again, this is work that he's done, his proprietary sort of cycle work that he looks at. But basically, as we look at where we are now, you can see that we are effectively starting what he believes is going to be a cycle that can actually, fuel us for the next good amount of time. Frankly, the fact that the market could be really just bottoming out here and in store for a much longer move, not just a bear market rally, but something that could last even longer. And if we look at, again, just another slide from his presentation, again, this is his work, not mine, but he also is charting a 10-year cycle pattern. And he spends a lot more detail explaining these charts. So again, check out that video. But basically, we've got a confluence here of cycles that are basically showing that the lows that we made back in June, just a month ago, might be the low for a longer period of time. And that, in fact, a bull cycle could be getting kicked off here while the market is in its most doubtful sort of view, or has, the most sort of macro negativity in its sort of crosshairs right now. So definitely some interesting things. I would again just recommend checking out the video. I wanted to pull it here and just at least share some of the charts that he talked about in his presentation. And I want to flip the script now because I wanted not to just have some bull evidence here or some bullish outlooks for the intermediate term, but I also wanted to bring some more pessimistic, and let's bring us down a little bit. And this is looking at the 10s minus 2-year Treasury yields. And so basically here, this is seen as, the recession indicator of sorts. Is when this starts to go negative, we tend to find ourselves in a recession in the next 3 to 6 months. There's various ways to look at it, but basically this ratio of 10-year yield minus 2 years is actually making new lows this week. And this is, by most regards here, there's really no other way to consider this but bearish. And the fact that it is making new lows this week is certainly counter to what maybe some of this cycle work is telling us. And so there are lots of mixed signals out there. Again, it's not an easy market. We're going to talk about price action and some actionable ways to maybe manage risk in part 2 here, but this is definitely more on the bear side here as this ratio starts to make new lows. So that is it for our free edition of Stock Market Weekly. Again, if you would love to continue on and watch the rest of this video, we're going to look at some more market breadth studies that I think are showing some interesting things, some new looks from some of the market internal measures that we track. We also are going to talk about price action and just a handful of charts and longer term trends. So if you want to continue on for another 15 minutes or so, definitely subscribe. You can head to thetraderist.com/SMW. You can buy this single episode, just this episode, for $5, or you can jump on a monthly plan and basically every single week get our extended version episodes for just $15 a month. Keeps you informed and keeps you up to date with basically all of our thoughts and latest market research. So that is it for me. Thanks as always for tuning in and watching. And for you that are continuing on, we're going to get started here in just 1 second.